Should we buy or sell the online retail ETF? First off, read this disclaimer carefully. And do your good deed of the day by liking and subscribing. So let's go here to the consumer cyclicals. And here we have online retail. 15% here from the 52-week low, but an astonishing minus 63% away from the 52-week highs. Here is the chart, weekly data points, and we have seen an absolutely spectacular downtrend. If we measure the duration of the uptrend, it lasted 329 days. The downtrend measured towards this low before this week, it was 462 days. So we have a very protracted downtrend for sure. This one is interesting because we have something that could become a bit, double bottom-ish. It's not a textbook double bottom, but this is an interesting low. When we go here to the daily data points, you see, if I just draw that in to make it very vivid, this purple 20-day moving average, it was a very key level here for the bears. It was a level where when they came back to short it. There's been some times where we were above it, some very temporary, some a bit more intermediate in the time frame. The interesting thing is that we are now again playing around above that purple 20-day moving average. It's not something that is like roaringly bullish, but it is an historical resistance level. So you see that during the early part of the downtrend, it was very difficult for the bulls to get above. Here they were above, for multiple days, and now with some ease, they were able to close above it. So there is a change. When we look at these other indicators, we are still very oversold. So very quote-unquote do at least a mean reversion. Same thing here with the PPOs and the MACD. Looking at the daily data points, we have seen some rally. Looking at RSI, there still is potentially some fuel left. So we have not yet reached the level that are like the type of levels that will spook the bulls. And so I think that they have reasons to rally a bit more. But when they get into this territory here, the previous fail levels, that is when it is very important for the bulls to really show some strength. So we have a major double bottom, and we have a breakout above the 20 daily moving average. So overall, it's bullish, but still, the bulls have a lot to prove. To the right here, we have the average seasonality over the last 5 years. Usually see some weakness here heading towards the 7th of June, 8th of June. That is when we see a nice uptrend for IBUY. To the left here, over the last 5 years, June is the strongest month. Over the last 7 years, June is the strongest month for IBUY. And July is not too shabby either. It closes higher 67% of the time. Average 4.4% gain. So the seasonality here for the coming 2 months is good. So I give it the seasonality for IBUY a 5. Let's compare IBUY with the XRT, the S&P Retail ETF. Going first to performance, we can see that IBUY has lost a lot more year to date, minus 47-ish% versus minus 27-ish%. Going here to beta, a bit higher beta. There actually is some yield, 0.55% versus 0.71% for the retail ETF. Holdings 75 versus 109. Yeah. So here you can see the sector breakdown. Yeah, how a stock is categorized. It's not really an exact science. However, market cap is very much more objective. So you can see here the market cap is relatively diversified across both ETFs. Okay. Here we have some other metrics here from ETF.com, like value, quality, yield, volatility. Yeah, so ETF.com, they also have a pretty decent comparison tool that I think I might use more going forward. I think I give the fundamentals here a 1. Let's look at correlations. So we do have 63% with the S&P 500 long term, 79% with the XRT retail ETF, 72% with XLI consumer discretionary ETF, then minus 87% negative with the dollar index. Daily data points, 79, 80-ish% with the S&P 500, 97% with XRT, 87 with XLI, and minus 85% here with the dollar index. So what happens with the XRT is very likely going to have an effect on this more specific ETF. The thing is that I did look at XRT in another video, the one about Yeti, so maybe I should look at there was a rather negative relationship with the dollar index, which means that what is, like, if there is reason to expect the dollar index to go down, that is likely then to be bullish for the IBUY ETF. So yeah, here we have the dollar index weekly data points, and we are seeing that we just now, well, very recently at least, we entered a territory that's been a fail level for the bulls in the past. Like around here, this is a level where they have a tendency to get into trouble. So that's it's interesting to see it happening at this repeatable level. Previous times it's marked major highs, and we have seen very substantial pullbacks. Obviously, we don't know right here and right now whether that will happen again. As you can see here, there are some pretty decent time cycles here for the dollar index. Rise, decline, rise, decline, rise, decline, rise, decline, rise, decline. I mean, it almost looks like you can print money, but obviously, time cycles, they can change. But it is quite fascinating that the time cycles have been so clean for such a long time. Given that we are approaching that upper end, well, the final phase of the bullish part of the time cycle, so there's a major declining phase extending into August 2024. That is obviously a very big picture, but nonetheless, it's interesting. The recent pullback, it came from a very overbought level across the indicators. Looking at the daily data points, as RSI, it has cooled down to a level here that, at least during this major uptrend, it has attracted the bulls. So you see that the bulls, they do have a tendency to buy the green 50-day moving average and also the blue 100-day moving average. We are not at the 50-day yet, but it's something to just be aware of, that if we were to go down to the 50-day, then definitely look at what the bulls are doing. If we do see something like this, then there's a decent probability that they will try to actively form a support level. I am here comparing the online retail ETF with the dollar index ETF, the UUP. So yeah, and here we can see the double-ish bottom pattern. We are at the very low end of RSI, and yeah, it looks a bit similar. But that's not a huge shock either. Looking at the seasonality, yeah, we do see that the leading here up until 21st of July usually is decent for for the IBUY ETF, meaning it has a tendency to outperform. Let's compare the IBUY against various ETFs that could be alternatives to IBUY, because the type of investor that wants to buy the online retail ETF might consider buying the Cathie Wood's ARK Innovation ETF. So here we do see the relationship, and something interesting jumps right out of the charts. This looks a lot like a rounding bottom, but you can see that it is a bit jagged. Given that, we then have to look at whether there are some repeatable time cycles or not. And it's not, super clean, but there's something here with these time cycles. There's a bit more left here in the rising phase, meaning online retail could outperform and the ARK K, but there is a bit of a declining phase as well around the corner. That is the next major move, and the time cycles here have been clean-ish. So let's look a bit at the seasonality. What do they corroborate? Okay. So looking at the seasonality here, it is very good. Well, it is good for IBUY. It has a clear tendency to outperform the ARK K ETF. So that's interesting. Okay. So yes, it does corroborate the idea that there could be more left in the rising phase. Here I am comparing the online retail ETF with the emerging markets internet and e-commerce ETF, the EMQQ. Are there time cycles? Maybe there are time cycles here. Well, they might have differed a bit in duration, but yeah, something time cycle-ish. We are at, a very low end of RSI here. So just from like a pure RSI perspective, it is possible that we are just at least going to see some mean reversion, where the IBUY outperforms EMQQ. Simply based on that, we have seen that historically there's a clear relationship here between low end of RSI and price rebounding. Okay, so let's look at the seasonality. What does that corroborate? So looking at the seasonality here over the last 5 years, so towards late June, IBUY has a tendency to underperform the EMQQ, but this is when it forms a low, and we usually see outperformance leading into the 10th of August. But there is a caveat that we don't have much data about IBUY. So I give IBUY a 3 on relative performance in favor of the bulls. So we end up with a 3.3. So the data is more supportive of bullish than bearish trades. A key part of this bullish thesis is double bottom, and we do have 20 daily moving average breakout. So a level that usually formed strong resistance. It was a level where the bears kept shorting and making decent profits. It's now a level where the bears don't feel that confident anymore. That doesn't mean that the bears are completely out of the picture. It does, however, mean that the sentiment among the bears has changed, because the market is very simple. So whenever you look at a security, the question you have to ask yourself, will there be more buyers or sellers? If there are more buyers than sellers going forward, then it will go up. It's that simple. If there are more sellers than buyers, then it will go down. And I do think that there are some changes here with this ETF that makes it more challenging to be a bear. And if we do get, that, critical mass now of bulls, then we can see a nice uptrend for the online retail ETF. Whatever you do, of course, you must use stops, because if we do not get enough bulls, getting into IBUY, then the bears could get very ambitious. And we have seen that many times throughout, stock market history, that even some of the strongest stocks on the planet, the strongest companies, take Amazon. Amazon is a rather powerful player in the e-commerce space, to say the least. But if you look at the chart of Amazon, there's been many times where it just got absolutely butchered. So if you sat there and just held on through the bad times, it would be a very bad idea. Because while Amazon survived, there were many companies that looked very similar to Amazon that did not make it. So there's no alternative really to using stops. And even though, sure, if you bought the IPO for Amazon and held on, you would make very good money. If you bought the IPO of Amazon and you systematically got out near the highs and got back in near the lows, then you would get substantially better gains than those who just held on through the IPO. Further, you would also then be able to get gains from the Amazon-like companies that didn't make it, and there are quite a few of those. Here is a very interesting tool that I have made that calculates how far various securities have fallen from high to low, and how much it must rally to simply break even. So let's take Virgin Galactic here as an example. From high to low, it has lost minus 88%. That is obviously pretty big. Just for it to break even, it must rally 709%. And if you look at this from like a long, short perspective, instead of looking at minus 88% with horror, you will see, wow, that was amazing, bearish opportunity. And this, instead of looking at this with horror, thinking that, look at how much it must go up for it just to break even. Well, this is a potential massive opportunity for a bull. Let's quickly illustrate the merits of a stop loss with Amazon. So this is approximately from the IPO level, and here are two traders. One person here could have a max gain here of 6,452%. That obviously is pretty good. You have to use some kind of stop level, and you can see here how quickly those gains disappear. So already here, the person has lost more than 1,000%. That's a lot. Losing 1,000% on a position is big. And that is 1,000% that was in the account, but because it wasn't closed, it disappeared. And all the way down here, you can see that, it dwindles down to 243% here towards this low. 243% gain is obviously good, but if that meant that you lost thousands of percent that you could have closed out as gains, that is very substantial. And you can see here that between 2003 and 2006, Amazon lost minus 59% here, and between 2007 and 9, it lost minus 66%. So even the best e-commerce company of all time has had huge losses, huge drawdowns where the market was, from a long-term perspective, completely wrong. Notwithstanding that, you had to use a stop because the market, it can be more irrational than you can be liquid. So yeah, always use stops.